Hey, in this video, we're going to break down what RBC Capital Markets has to say about the state of the economy and S&P 500 price targets for next year. We're going to talk about their bear case scenario where we look at a potential market correction, why that might happen. We'll also look at some charts to understand what's driving this market and where might some opportunities be compared to other options. Let's jump into it. So RBC Capital Markets put together this about 55-ish page report. Actually, it might be a little longer than that. But either way, 95 page report. And they start with a nice little summary. And then what we're going to do is we're going to go through the summary and then we'll jump into some of the details that we have, including some of the charts they give us, which are really incredible. So 10 things as the new year comes into view. First, they think that the S&P 500, first and foremost, is going to go up to 6,600, which would represent about a 10.6% year-over-year gain. They do think that there is a chance that their bear case will end up leaving us below 6,000 for next year, but that is not their base case. In fact, they think there's actually a chance for a 5 to 10% pullback in the S&P 500, primarily due to elevated positioning, recent froth and sentiment, and valuation that has gotten a little over its skis for 2024. Now, in other places, they mention a potential 15% drawdown, but the argument here is simple. They, on their base case, think the stock market will go up by the end of 2025. But they do think we are a bit vulnerable to some bad news when and if we get bad news, and that the market might be primed for a breather, especially since we've got Fed rate cut expectations that are being dialed back, only a 66% chance now being priced in that we'll actually end up getting a 25 basis point cut in December. We're sitting at 10-year yields, which are finally off some of their highs, but I mean, we ran all the way up to 4.5 and a bit there for a moment until Bassett was chosen by Donald Trump for Secretary of Treasury, which is great, subject to confirmation and might help calm some of the tariff concerns down. But markets are also only pricing in a little bit more than a coin toss for that 25 in December. Now, they do think that seasonally we should be good in November and December, but we're prone to weakness in January and February. Now, there's something interesting to pay attention to here. First of all, the yield curve is only uninverted by about 2 basis points, and usually if you get some bad news, some kind of shock that's going to shoot up 50 to 90 basis points, that could be recessionary in itself. But I'll tell you, we've gotten a lot of insulation, and I want to be really clear about this because I think it's remarkable. But if you look at the NASDAQ 100, we have done the unthinkable, which is we accomplished the Nike swoosh. Look at it. Throughout the end of 2022, when I launched my exchange-traded fund, I talked about the Nike swoosh coming. And the Nike swoosh is exactly what we got, which is remarkable. Now, that doesn't mean that I don't make mistakes. I moved to bonds a little bit early. I think we all already know that. And that's because I like to be where's the screenshot? There it is. I like to be as transparent as possible with what's going on, so that way we can learn from mistakes that are made or learn from things that are called correctly. And so what I'd like to point out is if we take a peek at where we began calling the Nike swoosh, we saw that happening right about here. And unfortunately, I started getting more nervous for recession in July, which was really before the August sell down. It was right about there. Now, obviously, we've recovered from then, but what's remarkable is we're actually not that much higher than we were in July. In fact, right now we sit just 1.5% above where we sat in July, which means from July to November, the NASDAQ really only gave us 1.5% as an index in total. Most of the gain happened at the beginning of the year. And this has some folks wondering, okay, we're getting this expansion, but things are definitely starting to get a little bit rich. And we don't mean rich like Justin Trudeau now showing up at Mar-a-Lago to try to maybe, how should we put it, cozy up to Donald Trump to limit those tariffs. No, we literally mean that from a valuation point of view. If you ever follow the channel or the group bar chart on X, they have a pretty decent outlook frequently, and they give you some charts that are interesting. Take a look at this. The Warren Buffett indicator has hit an all-time high, more than 203%, surpassing the dot-com bubble, surpassing the global financial crisis, and obviously well above the bear market, or I should say the sort of peak euphoria that we had in 2021. I think that's what they mean to say with this. So pretty remarkable in terms of where we sit in valuation. Pretty expensive. This is the Wilshire 5000 to GDP ratio. A lot of people look at this and say, okay, yeah, we could definitely afford a pullback. The question is, will a pullback be recessionary? See, when you get a pullback in the stock market, that's when you could lead to unemployment rising. And unemployment rising could potentially coincide with the seasonal weakness that you tend to get in January and February. And that, to me, is a big risk factor we'll want to pay attention to. So they also mention that there's a lot of froth that has been sort of baked in October and November, and that sentiment is constructive, but they do recognize there's a very clear potential here of a near-term pullback. And so at least if we're listening to them, you've got to buy the dip opportunity potentially coming up with just a little bit of bad news. So far, though, a lot of things seem very tactically bullish. Every single one of these appointments that we keep hearing about from Donald Trump continue to be supportive to the idea that Donald Trump is going to push for a strong business-friendly and stock-friendly environment. Talks about him working with Jamie Dimon or some of the appointments to the example Treasury, like we mentioned earlier. These are bullish to both stocks and bonds. Now, they do say here that we don't see a lot of room for price-to-earnings multiple expansion, but they do think stocks can still go up, and that's because they still see earnings somewhat moving up next year, though not much more than bonds. And this is an interesting note because this is sort of my case right here. They say U.S. equities may soon lose their appeal relative to bonds, but have not done so yet. So even though we've got earnings coming up, we've got margins that are doing better at companies, we're still in a position where valuations are so high that the expected return of equities in the S&P 500 compared to the bond market today just isn't that good. And then it makes you sort of question, okay, well, why not buy risk-free bonds? And I'll give you a trade we've talked about many times before. We talked about this quite a while ago in our course member group, and we talked about this many times, and we'll talk about it in just a moment right after I give a quick shout-out to the Black Friday sale. Make money under Trump. Get the Trumponomics course. This is all about positioning your family, your wealth, your stocks, options, crypto, real estate analysis, your job, your career, your entity management, everything that people have asked me about as I worked for them as a financial advisor. It's all going into this. Now, obviously, it's not personalized advice for you, but it's the best of everything that I've given coming into this course in a simple, streamlined manner for 2025. Now, a lot of you were bundling this course together with the Diamond course to basically get all access to all of the existing courses. Those will go super deep dive into things like property management and rental properties and real estate investing, 0 to millionaire. Super deep dive courses, and they're really, really valuable. The 2025 Trump plan is going to get you the bottom lines to get in and to the next level. On really deep dives, bundle this with that, but boy, start with that Trump course. It's going to be great. Check it out at meetkevin.com. Sale is on for Black Friday. All right, so look, right now, there's in my opinion, this commentary here about bonds creates a trade opportunity. See, in other words, they say stocks' appeal relative to bonds has diminished. It has not eroded enough to call for a decline in stocks, but a lot of people are looking for a potential rotation to where bonds could potentially outperform the stock market next year. And I actually think that's exactly what's going to happen. In fact, I'm a big believer that inflation is basically dead. We have an oversupply of inflation, or of products rather, in supply chains, and therefore we're going to continue to see disinflation in goods and services. Not necessarily in food, which is much more volatile. Energy we expect to come down. Housing services we expect to come down. But this is a very interesting one because when we look at something like a TLT and we compare back to the pandemic, we can see that during the pandemic, when rates moved all the way down to, essentially zero, and we were printing money like crazy to get out of a recession, we saw TLT move all the way to $160 per share. This security has about an average maturity of about 25 years. People see it as the 20-year to 30-year bond ETF. And what you've got here is really a stock that's an ETF, essentially, that's bobbing around what I call the Jerome Powell floor. This floor over here was the depth of sort of the stock market sell-off at the end of 2022, the CHIPS recession, and still not peaked out yet on interest rates from the Federal Reserve. This floor over here at the end of 2023 was the Bill Ackman 10 years are going to shoot past 5%, and as soon as they got to 4.9%, he covered his shorts and went long bonds, calling them the greatest opportunity ever. This low over here was representative of the beginning of 2024 second wave of inflation fears. This drop over here was representative of Donald Trump. Oh no, he's going to have tariffs and he's going to cause all this Trumpflation. Oh no, oh no, oh no. And now, folks, on the weak candlestick, we are finally creating our first bounce off of, again, what I call the J-Pow floor. I believe 98 is an easy in-the-bag move for TLT, potentially even by the end of January, Jan 17th for options, right? But I actually think that by the end of 2025, the Nike swoosh that we've had in the NASDAQ 100 will end up being the Nike swoosh of TLT. And as I was right about the Qs, I think I'm going to be right about TLT. If not in 2025, then in 2026. But I think we're going to trend in this direction throughout all of 2025. Yeah, there'll be volatility, just like with the Nike swoosh, the volatile Nike swoosh. But I think it'll come, and we'll see yields basically fall as we try to support and prevent the economy from going into recession. And so therefore, my base case is 110 on TLT. Though I kind of think we're probably closer to 120, 130. If we go into a recession, we will probably revisit the 130 to 144, maybe even 160 range. And the way some people are playing this is call options. No guarantees. I hope the best for everybody who makes investments as always. I just can't make any guarantees for you. Anything can happen. So going in over here, it's interesting to see them comment on this, though, because that is a thesis that's been circulating. Let's take a look at this. The U.S. economy is at an important crossroads from a stock market perspective. Okay, interesting. Tell us more, please. All right. So they mention here that real GDP is expected to come in at 2% in 2025, a number that's been moving up recently. So in other words, estimates have been coming up for GDP, which is fine. People are more bullish. But RBC actually thinks that we're only going to see about a 1.9% level in GDP, which is still pretty positive and aligns with their base case scenario, but they're a bit more bearish than markets are right now. One of the reasons for that is they think that elevated interest rates may start biting into the amount of spending that people are capable of doing right now. They think people are sort of running on fumes and that the last bit of spending might disappear. And that while markets have priced in all the upsides for Donald Trump, they may not have actually priced in some of the risky downsides of what ends up happening if we end up getting a 2018 where the stock market returned negative 6.2% in the only down year in Donald Trump's first term, and all of a sudden that same thing happens next year. Now, is a 6% downturn really scary? 5 to even 15%? No, of course not. The market's up way more than that, so who cares? But the question is not, okay, who cares about a 5 to 6% downturn? The question is, does potentially a 5 to 15% downturn become the straw that broke the camel's back, and it ends up leading to a negative 40% downturn? That's the question. Now, what do you have over here? They give an edge to value over the growth, they say, but it's a little unclear. And they expect small cap to stay pretty choppy, mostly because they think GDP has to grow a lot more than it has been in order for small caps to kind of keep benefiting. Now, here's some interesting charts that you want to pay attention to. AI in particular appears to be benefiting larger firms more than smaller firms. This is not a surprise to me since larger firms have more capacity to say, hey, let's institute an AI policy and wow, we're going to save so much more money. A small company isn't going to save as much money from artificial intelligence as a large company. So it makes sense that when asked over the past 12 months, has your firm utilized AI to automate tasks previously completed by employees? You had over 50% of large firms saying yes, and only about 25% of the larger firms, the smaller firms saying yes. More of those smaller firms, closer to 70% of them, actually saying no. I found that very interesting. This was another one. Deep cuts and lengthy recessions are usually what makes a small cap stock outperform. However, if you have a soft landing or a quick recession, you generally don't end up having small cap outperformance. You tend to have large cap outperformance. So they're basically saying, hey, if you're betting on small caps to outperform, small caps would do better with deep recession, not quick soft landing. That is in their opinion. So I'm going to make that little note there. Some of the other ones I highlighted over here, small caps have underperformed in the past when job growth has slowed. We're about to get a jobs report 1 week from today, so we'll see what we get. Who knows? Maybe everybody's hiring again because things are booming. Look at the inflows from small caps and large caps. Massive inflows at small caps and large caps here. Some of the highest that we have seen since, quite frankly, June, which actually, hold on, is that true? That's a little bit scary because look at this. If I take, let's see here. Let's grab this arrow. Let's draw that straight down. Yeah, look at that. That's right there about the beginning of July. That level right there. That was the top of the market. So that's a little bit scary that we're sort of aligned with that, along with inflows over here in March. That was also a local top of the market. So those inflows, people tend to buy stocks right when they're at their highest, right? Anyway, okay, let's look at some other pages that have been highlighted. Patience is really hard in the stock market. History suggests above average GDP needed to help small caps beat large. Top 10 names have much better balance sheets than the rest of the S&P 500. Yeah, I mean, this is just really saying like, hey, large cap is just beating the reason the Mag 7 are beating is because their balance sheets are so much stronger. Totally agree. Buy side positioning in mega cap growth funds, futures back to all-time highs. Yup. It's a safe place to be, and it makes, when you go all in on the Mag 7, it's really hard to lag the S&P 500 or QQQ. The NASDAQ 100. A lot of people are very benchmark sensitive, and they just sort of compare your performance to a benchmark. But that really sucks when the benchmarks are losing money, and the strategy that people should have been in is now making a lot of money, but everybody's just comparing to the benchmark. Oh, well, the benchmark is down 10%. You're down 11? Oh, okay, close enough, or 9. Oh, you're beating the S&P 500? So how about positive? I actually think the more exposure you have to bonds, we could potentially get you outperforming the market next year. We'll see. Trump's favorability has been improving, as so has consumer sentiment. Big boosts in consumer sentiment, by the way, after the election. We were covering that a little bit this morning on the channel as well. Looking for, what was this one? The S&P 500 recovery has been tracking the recovery of consumer sentiment. Well, that does sort of imply that because consumer sentiment has been booming after Trump, that it's possible the recovery just keeps going, right? Earnings yield gap is heading towards a troublesome range for stocks. This is just basically a way of saying if you take the S&P 500 earnings yield and you subtract the yield on the 10-year treasury, you've actually gone negative. And going negative, it means bonds are expected to yield you more money than stocks. The last time we had that was over here in like the dot-com bubble, right before the dot-com bubble recession, which is not good. We've also seen this sort of negativity briefly here in 1994, which was associated with soft landing. And you did also have that leading into the 91 recession, but you did not have that in the 2008 recession. So, little things to pay attention to. And then the last chart we have right here is their bear case price target. We already have their bull case price target, so here's the bear. Bear case price target, 5775. It's really just not that bad. Like, really, there's There's no reason to dump the S&P 500 or the NASDAQ with that sort of forecast, right? Like, that just says, hey, man, just buy the dip, like, whatever. Again, the biggest concern is just, is it possible that a correction leads to a recession? Who knows? I think we are on the edge of a lot of joblessness. So personally, I'm nervous, but I'm hopeful, because trust me, for all the startups and all the businesses that we've got going on, the last thing we want is a recession. We will benefit from not a recession, as most people would. So yeah, there we have it. So with that said, make sure you are part of the Trump course. A lot of people, by the way, are missing this section right here where I talk about we expect 70% of the course to be live December 17th. 30% is going to be reserved for future updates. Now, that's really important, because if Trump comes out with new policies, I want you to know you're going to get those updates for free. And what a lot of people are doing too is when they go to the pre-order page and they see this is only $2.99, which is a great deal, what a lot of people are doing is they're jumping in over here and they're actually adding in these Black Friday exclusives, like the wealth plan, the Black Friday all access special for all of the courses, so you can start learning right away. Shadow Meet Kevin. You can add these very simply. You push the button and it adds to your cart. Very easy. A lot of people are adding this in. So check that out. It's all over at meetkevin.com. Thanks for watching. Happy Black Friday, everyone. Goodbye. Good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.